Look at a stock that just surged 90% in a single month from its March lows, only to show a slight pullback to $1.83 today. Are you looking at the ultimate undervalued opportunity, or are flashing sell signals warning you of a massive value trap?
Right, because it really could be either one at this point.
Exactly. So today we are going to decode the financial reality, the technical analysis, and really the extreme market tug-of-war surrounding AMC Entertainment as of today, April 20th, 2026.
And it is a massive tug-of-war.
Oh, for sure. But before we pull apart the balance sheet, a quick reminder to hit the like button, subscribe to the YouTube channel, and absolutely leave your own theories in the comments. We want to hear where you stand on this.
Yeah, and just to be super clear right up front, this entire natural debate is purely an educational analysis of the data. This is absolutely not financial advice.
Right, no financial advice here, just two people looking at the numbers. And speaking of the numbers, I mean, you have this 90% monthly surge, but then you look at the underlying business reality, and you have to wonder how the stock price aligns with the company's actual bank account.
Well, frankly, it doesn't.
Right. AMC closed at $1.83 today, which is down about 1.61%.
Yeah.
And it's sitting in this 52-week range of 93 cents at the bottom and $4.08 at the top.
Yeah, and if you look at their fiscal year 2025 income statement, the story is pretty wild.
Okay, lay it out for us. What did they actually make?
So total revenue was $4.885 billion.
Wow. Okay, almost $5 billion.
Right, huge top-line number. But they are still operating at a net loss of negative $632.4 million.
Wait, so they brought in nearly $5 billion and still lost over $600 million?
Exactly. The earnings per share, the EPS, is negative $1.34.
That is just wild to me. It feels like a blockbuster movie that grossed over $4 billion at the box office, right?
Mm-hmm.
But the production and the marketing budget was so incredibly bloated that it still lost money.
That's a perfect analogy, honestly, and it gets worse when you look at the balance sheet.
Right. Let's talk about the assets versus liabilities.
So total assets are sitting at $8.02 billion.
Okay, so theaters, equipment, leases, all of that.
Yeah, all of it. But against that, you have a staggering $9.91 billion in total liabilities.
$9.91 billion. So if we do the math there, that leaves a negative equity of negative $1.89 billion.
Right, nearly $2 billion in negative equity.
So if they sold everything, literally every popcorn machine, they're still $2 billion in the hole.
Yeah, and their total cash on hand is only $428.5 million.
Which sounds like a lot of cash until you realize what they owe.
Exactly, and their levered free cash flow is negative $114.83 million.
Let's pause on that. Negative levered free cash flow. That essentially means after paying their basic operating costs and the interest on that mountain of debt, they are just bleeding cash.
Yes, bleeding cash. So if the company's equity is negative almost $2 billion, the logical question is, why are buyers still piling in?
Right. If the fundamentals are this bad, why the 90% surge?
Well, you have to separate trading on fundamentals from trading on momentum.
Okay, explain that a bit.
So with a negative PE ratio of negative 1.37, traditional analysts are looking at this and screaming that it's overvalued. But retail investors, they see something else entirely.
They see the momentum.
Exactly. Because the fundamentals don't explain a 90% surge in a month. You have to look at the technical analysis to see what the charts are actually doing.
So let's pivot to the technicals. What is the trend direction right now?
In the short term, it is undeniably bullish. The stock is trading above its 50-day moving average, which is at $1.21.
Okay, so it cleared the 50-day. What about the 200-day?
Well, it hasn't conquered the 200-day moving average yet. That's sitting up at $2.17.
Right, so that's going to act like a ceiling.
Yeah, a major resistance level. But before we even get there, there's immediate resistance at $1.94, and then, of course, the psychological barrier of $2 flat.
$2 is always a huge mental hurdle for retail traders. And what about the floor? Where's the support?
The support anchors seem to be established at $1.64, and below that, $1.45.
Okay, so we have our playing field. But what about the actual momentum signals? Because I was looking at the RSI, the Relative Strength Index, and it is screaming.
Oh, it is absolutely screaming extreme overbought. It's sitting somewhere between 82.74 and 89.58.
Wow.
Yeah.
Is an RSI pushing 90 basically like redlining a car engine? Like, yes, you're going incredibly fast and the momentum is thrilling, But aren't you at a severe risk of blowing a gasket and triggering a short-term correction?
I mean, yeah, the redlining analogy is spot on. When the RSI peaks, this high short-term weakness or a sharp pullback is highly, highly probable.
You just can't sustain that level of buying pressure forever.
No, you can't. But, and this is where it gets complicated, the MACD indicator is showing a bullish, positive momentum shift.
Wait, really? Even with the RSI that high?
Yeah, and the volume on up days is heavily outstripping the down days. So when it falls, volume is light, but when it rallies, the volume is massive.
So the engine is redlining, but people keep pouring high-octane fuel into it anyway.
That's one way to put it.
Which brings up the next obvious question. With the engine redlining, who exactly has their foot on the gas pedal right now?
Following the money here is fascinating. Let's look at insider activity first.
Usually, if a company's bleeding cash, insiders are abandoning ship, right?
You'd think so, but it's surprisingly positive here. In the last 100 track trades, insiders bought 7.68 million shares.
7.68 million bought. How many did they sell?
Only 3.72 million sold.
Okay, wait. That's a huge net positive.
Right. Now, full disclosure, February 2026 was kind of neutral with tax and award disposals, but overall, insiders are buying.
That is bizarre, given the balance sheet. And what about the options traders?
Oh, options traders were wildly bullish just days ago, around April 17th. The put-call ratio was microscopic.
How microscopic are we talking?
0.14.
Wow.
Yeah, across 349,000 traded contracts, people are betting heavily on the upside.
And institutional ownership is sitting at around 28.8%, right?
Yeah.
So this is heavily retail dominated.
Very much so. But here is the massive contradiction. Wall Street analysts vehemently disagree with the options market and the insiders.
I mean, they look at that $9 billion liability number and panic.
Exactly. The consensus rating on Wall Street is reduce, with a score of 1.8, 6 out of 4.
Ouch. What's the breakdown of those ratings?
You've got exactly 1 buy, 4 holds, and 2 sells.
So almost nobody thinks it's a buy from an institutional perspective. And what are their price targets?
Wildly split. The average is $2.32.
Okay, a bit higher than where it is now.
Yeah, but Wedbush has a high target of $4, while Citigroup is all the way down at $1.10.
Wait, so let me get this straight. Insiders are buying millions of shares, options traders are betting heavily on the upside, yet Wall Street analysts are slapping a reduce or sell rating on it with price targets as low as $1.10. Who usually wins a tug-of-war this extreme?
Honestly, it perfectly illustrates the massive divide between institutional risk assessment and short-term market mechanics.
Right, they aren't even playing the same game.
No, not at all. Institutions are looking at 5 years out, and retail's looking at next Friday.
Which brings us to the real debate here. Is this a truly misunderstood, undervalued turnaround play, or is it a dangerous value trap waiting to spring on unsuspecting retail traders?
Well, let's look at the bull argument first.
Ah.
Retail bulls are actively arguing for short squeeze potential.
Oh, the classic short squeeze.
Yeah, they're using the high volume and this intense momentum to trap short sellers. If the price keeps pushing, shorts have to cover, which drives the price even higher.
Okay, but what about the downside risks? Because the critics point to the stock being entirely unmoored from fundamentals.
It is unmoored. The extreme volatility and the constant threat of continued share dilution create a highly dangerous environment.
Yeah, let's talk about dilution. Betting on a short squeeze feels a bit like playing financial musical chairs. When the music stops, it's usually the retail traders who get caught without a seat. Why do retail traders so often get trapped in these specific setups?
Because they focus on the price action and ignore the mechanics of a value trap. You have that massive $9 billion liability load hanging over every single rally.
Right, because if the stock goes up, management is tempted to issue more shares to pay down that debt.
Exactly. They dilute the stock, so any slip in momentum leaves retail holders holding the bag. The company survives by taking money from the retail traders who bought the top.
That is brutal. So to give the listener a complete roadmap here, can you clearly lay out the absolute best case and worst case scenarios for the coming months and years?
Sure. Let's start with the short-term catalysts. There's a real risk of an immediate technical pullback because of that high RSI we talked about.
The rubber band has to snap back.
Exactly. But it's battling against some fundamental positive news. They just had a record Easter revenue.
Oh, right. The box office was packed.
Yeah. So In the medium to long term, all eyes are on the upcoming Q1 2026 earnings report on May 6th.
May 6th.
Yeah.
Mark your calendars. So what's the worst case scenario coming out of that?
The bear case, the worst case continuation lower, is that the insurmountable $9 billion debt load simply catches up.
Right. They can't outrun it.
No. It results in massive continued dilution just to keep the lights on, wiping out current shareholder value entirely.
Bringing the stock back down below $1. Okay, but what's the bull case? What's the best case recovery?
Well, they did have a recent $425 million debt refinancing.
Okay, so they moved some debt around.
Yeah, they successfully pushed maturities out to 2031.
Wow, okay, so they bought 5 years.
Exactly. Combined with a strengthening movie slate expected in late 2026, the company's projection of becoming free cash flow positive in 2026 could actually materialize.
Wait, I have to ask about that refinancing. Does successfully extending debt maturities to 2031 actually fix the core problem? Or is management just, hitting the snooze button on a $9 billion alarm clock?
That's the billion-dollar question, right? Buying time is sometimes exactly what a company needs to execute a turnaround.
If they use the time wisely.
Right. If they can actually become cash flow positive as projected. You can't fix a business if you go bankrupt tomorrow. Hitting the snooze button gives you a chance to actually wake up and change the outcome.
That makes a lot of sense. So just to summarize this high-stakes balancing act for everyone listening, we're looking at a stock buoyed by 90% monthly momentum and incredibly bullish options activity, right?
Yeah.
But it is anchored by an extreme overbought signal, a reduced consensus from the pros, and a deeply negative balance sheet.
It really is a fascinating standoff, and it leaves us with kind of a provocative thought to mull over.
What's that?
Well, with AMC's debt execution pushed all the way to 2031, if retail traders manage to hold the line on the stock price until that late 2026 movie slate hits, does it force institutional Wall Street to finally admit that retail momentum is a permanent, measurable asset on a company's balance sheet?
Wow. Can retail loyalty actually be quantified as a financial asset? That's definitely something to think about. Thank you so much for joining us on this deep dive into the numbers.
Always a pleasure to dig into the data.
And to you listening, don't forget to like the video, subscribe to the channel, and definitely drop your answers to that final question down in the YouTube comments. We'll see you on the next deep dive.